Exactly, right? So
Yeah.
it's 100 minus your age is how much you should have in stocks and bonds. And so if I'm 50 years old, I should have 50% in stocks, 50% in bonds.
And welcome into Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, your resource, ladies and gentlemen, for proactive guidance and advice on what to do with your money, your investments, your finance to plan for and achieve a more stable and secure retirement. Personalized planning is what happens there at TJ Stearns. They put together the Protect and Grow written retirement blueprint. And Tim, the market's been holding relatively steady, although
Yeah.
there have been a couple recent days where headlines really create big swings in the market. And relatively, we're still at or near all-time highs. So is market volatility still something that we need to worry about?
Yes. I mean, when we speak to baby boomers and that type of thing, that's one of the biggest fears they have is that it could all get wiped out. Like we've seen back in 2008, in the early 2000s. They're very scared of that because think about it. Back then, they were going to, they were 20 years out from retiring in some cases, and now they're, on the cusp of it, or they've already retired, and they can't have that. And a lot of the people that are calling to the show are people who are don't have a plan, and they don't have a exit, they just think that they need to pile up as much money as they can, as fast as they can, and then they can retire. And, they don't know how to unwind it. And there's just so many things. And then to add volatility to it, the anxiety that we're hearing from people when they call into the show, it's unbelievable.
Well, again, ladies and gentlemen, TJ Stearns Inc., Chicagoland's resource, the home of the Protect and Grow written retirement blueprint, addressing all pillars of a sound financial and retirement plan. And if you'd like to get your personalized Protect and Grow plan, just to kick off the show, want to remind you that Tim Stearns, CFP, makes that offer, that opportunity available to you. No cost, no obligation. It is a courtesy, complimentary service that they offer there at TJ Stearns Inc. All you need to do is reach out, start with a conversation about your goals, your timeline, your objectives, your concerns, your questions, and they will help you craft and create your personalized Protect and Grow written retirement blueprint that you can get there only there at TJ Stearns Inc. Just start by calling 800 640 2256, 800 640 2256, 800 640 2256. So, Tim, I mean, you answered the question. Even though we are around all time highs here, we should, yes, absolutely still be concerned with market volatility. Next part of the question is, when we see market volatility, is it something that we should react to at that time?
Well, I think that right now, when if your markets are at their all-time high, we should make other plans, right? Taking like a log off the fire and making sure that you are not taking the undue risk. Enjoy your gains. And as my dad used to say, pigs get fat, hogs get slaughtered. Make sure you're understanding what your amount of risk is on the table. And if you're comfortable with that and knowing that you could lose, that we've seen, 20, 30%, in a year, then okay. But I mean, I think a lot of people that doesn't sit well with them. And I think that they're almost in a quandary of what to do, paralysis by analysis, whatever the analogy you want to use. And so we're trying to help them get through it by saying, let's have a plan where you have some of your money at risk and you have some of your money that's guaranteed so that you're earning enough money to cover your bills during the month. And then the rest is gravy. And I think that that's really appetizing to most of our listeners.
So not react, but be proactive. Like, let's act now before the market volatility, as we are at this place where relatively near all-time highs, maybe a point or two or percent or two off. That probably shouldn't matter in formulating a plan. If we've moved a day or two or even a week
Yeah.
or two from all.
Yeah.
However, what we're trying to avoid, Tim, is those major declines, like you talked about, a 20, a 25, a 30% return, negative, right? Losses there, would absolutely change our perspective and outlook on what we think the financial future looks like. I mean, you're talking about losing 1/5 to a quarter to a third of your life savings. That's absolutely going to change what retirement is about for most people.
Right. And so, I mean, let's not be too greedy here and make sure that we're taking a step back. And by doing that, we analyze when we do a protect and grow plan, we analyze what the risk is. Most people, when we finally get down to brass tacks and show them how much risk they're taking for the amount of reward, they're not happy because they realize that they've gone really above and beyond where they want to be in their comfort zone. And so we're showing them this is how you need to, take it back a little bit and get a little more diversified, have some, I have these one people that we met through your our show here, and they had over 80% of their money in a high flyer stock. And they, just thought it was going to go higher and higher and higher. And I showed them, what Oracle did back about 20 years ago, that it never really got back to where it was.
Right.
And that was kind of an eye opener to them. So now they're on task here, and we've got them, moving their money slowly but surely into something that's less aggressive.
Well, again, if you've got questions or concerns, feel free to give Tim Stearns CFP a call, 800-640-2256. That's 800-640-2256. Tim, it's like a state of ever ready preparation, right? Even though market volatility isn't here, it is always to be expected. And I actually I hearken back to the Fukushima disaster, the
Yeah,
earthquake that caused the
yeah.
tsunamis. Like
In Japan,
right, a lot of people all across the Pacific Rim were caught completely
flat-footed.
unprepared for that
Yeah,
tsunami, right?
yeah.
And since that time, they've done a really good job intentionally of putting in different warning platforms and signals and
Right.
ways to alert people. And so recently there was another earthquake there in eastern Russia, and the tsunami alarms were going off all around the Pacific. Now that one didn't end up being
Thankfully,
nearly
yeah.
as thankfully as catastrophic, right? But people were warned and were better prepared. So I guess my analogy here is, would you rather be unprepared and caught off guard, or would you rather be prepared even if we don't see that catastrophic market downturn, right?
Well, there's a reason we have, smoke detectors and that type of thing, right? So that we get the, and they might go off by a mistake here and there, but I'd rather have that than to have my whole house go up in flames, so I'd rather, point being is that people are taking way too much risk. They're, gambling on these high flyers, and I just don't agree with that.
But we're
And
taught to take risk. I mean,
I,
we are
yeah.
intentionally told you need to take risk, you need to take risk. Sometimes we're not comfortable at first, but we sort of build up that callus to where we become more comfortable with risk.
Right. And I think, speaking of callous and more comfortable with risk, I don't, I think people don't remember that, the markets were down in 2008, 36% on average. And, there's a lot of things out there that point to us being overvalued in the stock market. And, is AI the new bust? I hope not. I don't want to see people lose money, but I also know that, we've seen this story before. So let's, recognize our history in the United States with these different bubbles that we've had, and make sure that you're not on the other side of that. I think with baby boomers, they they haven't seen that in so long that they've become almost relaxed to it that it's not going to happen again, and I don't think that's the case.
I think AI probably not the same as the dot-com bubble
Sure.
back in the late 90s, right there, 2000, 2001, 2002, where we saw a 50% decline in the market because so much money had been put into one sector that was not yet proven. Actually,
Right.
now that I'm explaining it, it does sound even more familiar here and similar to what's going on. AI brought in tremendous amount of investment capital concentrated in that one sector. And so far, Tim, I mean, I know that there are parts of AI that have sort of worked themselves out, just like there were parts of the internet that had worked itself out
Sure.
back in the tech bubble. But there's a lot of it that is not yet proven. I mean, it's getting wrong answers. It's doing things incorrectly. And I've seen, people much smarter than me who are talking about the ancillary industries, microprocessors, the power supplies. They aren't in place to completely support this yet. So, could this be yet another bubble? Absolutely. We don't know. We don't know when any bubble is going to pop or grow, but that's why we need to be prepared for risk and really, Tim, assess the amount of risk that we are taking and quantify it and know it and understand it. Like be familiar with our risk, right?
Right. And I don't think many people are. And that's, one of the nice softwares that we have. We can shoot someone an email and have them answer some questions. And a lot of people say, well, I've done that when I opened my account at XYZ company. But for us, we can actually, they can't game the system. And they'll tell us literally a number as to what their reward is. And then, we'll put their portfolio in our software and it spits out a lot different numbers than what they're used to. And then we show them, here's what it did in 2008. This is what it did during the financial crisis. How do you feel about that? Are you comfortable with that and you understand it? Fine. But if you don't, then we need to make some changes. And I would tell anybody out there, if they want to give us a call, we're happy to run that analysis for them. We'll look at your risk.
Yeah, it's super helpful, enlightening. And the most important part of that, ladies and gentlemen, is the comparison, the side by side
Yes.
juxtaposition of what are you comfortable with? And again, specific questions that are geared to help you arrive at that conclusion. And then looking at your actual portfolio investments, how much risk are you taking? And I mean, even for myself, there was a pretty stark, significant difference there. And I know for many others, you've talked about it on this program, Tim. This is a surprising, just kind of initial analysis and assessment that you do with people's investments that is really eye-opening, just as kind of an intro to the conversation. But on a scale of 1 to 100, if our comfort level is a 50 and a lot of people are taking risk levels that are like 80, 85, 90 on that
Yeah.
same scale. Like that is a large differential, ladies and gentlemen. And the software and the questionnaires and the process that Tim Stearns, CFP, and his team there at TJ Stearns Inc. will lead you through helps you see that difference and then can talk over how you could make adjustments. Do you need to get more or less comfortable? Do you need to make some augmentations in your portfolio, some adjustments? They'll talk to you about personalized solutions with your goals in mind, a long-term time horizon, diversified strategies. That's the beginning of formulating that protect and grow written retirement plan. So pick up the phone, give a call to get that process started. Again, they can start that through emails and send in a questionnaire your
Right.
way. But the number to call, 800-640-2256, 800-640-2256, 800-640-2256. So Tim, when you look at that though, and you say, hey, in previous market conditions, both good and bad, here's what the market has done good, here's what the market has done bad. Now, here's how your portfolio, the positions that you own, would have reacted. And you show somebody where they have the potential of losing several hundreds of thousands of dollars, a quarter of their life savings, if similar situations were to come around again. Do people at that point in time kind of open their eyes and reassess the status quo and what they've been doing?
Right. The light bulb definitely goes on, and they'll at least temper their expectations as to what they're looking at. But the issue that we have is that a lot of people are still taking timely risk. And I'm concerned about the people who are, we call it the danger zone. You're 3 to 4 years out of retirement, or you're 3 to 4 years into it. And we talk about this in our book, Sequence of Returns Risk, where, that is going to set the stage. If your portfolio goes to heck, you're in a lot of problems, and you're running out of money. And what are you going to do? Go back, back to work? I just saw a study that, and we have a lot of people who come in here and say this, I'm going to work part-time in retirement. I can find work. And that's not really true out there. Yeah, you can get a jet part-time at Walmart or something, but I'm saying like the type of money that people are used to replace the money that you're going to lose in the market, it's not there. And so we're making sure that when we do the protect and grow, we're protecting their money. It's really simple to break this down, and then we're going to grow it, but we're not going to grow it like we're 20 years old anymore in the stock market.
Again, that protect and grow written retirement plan,
Yeah.
specific, customized for you, ladies and gentlemen. Pick up the phone to get the process started. 800-640-2256, 800-640-2256. Tim, I know there are some rules of thumb, but break them down for us. How
Yeah.
much risk should we be taking? How do we gauge that?
Well, let's go back. We'll go a little old school here. You have the modern portfolio theory, right? Which came out in 1952. So it's not that modern, but people are still using it.
It's about retirement age.
Yeah, exactly, right? So
Yeah.
it's 100 minus your age is how much you should have in stocks and bonds. And so if I'm 50 years old, I should have 50% in stocks, 50% in bonds. What we're finding are people are coming in here who are 60 something years old. Let's say they're actually 60, and they'll have 60% in stocks and 40% in bonds, which again should be reversed. So what do we tell them? We tell them that we need to trim back some of the stock portfolio and make sure that you're, more into bonds in that example. So the nice thing is the target date funds and that type of thing try to do that. Are they a silver bullet? Absolutely not. If you're over 59 and a half, our rule of thumb is you shouldn't be in your 401k. You should be in an IRA that you can self-direct or have an advisor help you, but at least you're in charge of your own destiny. And that's kind of where we go. So that's the one is modern portfolio theory. Again, it's not perfect by any stretch, but it's a better way to look at it than just, going for the gusto and trying to make as much money as you can in volatile stocks.
Well, let's break that down a little bit more, if you would, Tim, because I mean, I've got some questions about that. And let's just theoretically say that I'm 50.
Yeah.
I am not, but let's
Yeah.
theoretically say that I'm close enough, right?
Yeah.
Let's say I'm 50,
Yeah.
which would suggest that 50% of my money should be safer and 50% should be more invested or aggressively, or bonds and stocks are the two sides. So does that mean that 50% of my money isn't growing at all, and then 50% of my money is completely subject to the full fluctuation of the market? Like on both sides of that, I might
Right.
actually have some questions or concerns still.
Well, so if we, in our examples, if we go to cash or better yet, bond side, we're going to be in T-bills and they're paying nicely right now, over 4% risk free. I mean, you can't beat that. On the flip side with the stocks, we're not going to go into a concentration of, Nvidia and Tesla and last year, what was known as a Magnificent Seven. We're going to have more like ETFs and that type of thing and kind of tempering it. So we're taking, a little bit risk off the stock portfolio, but you're still in the market, but it's more diversified. Most of the people that are coming in with us have these concentrations of these certain stocks that are it's just way too much risk.
I actually heard something recently. I used the word concentration. I hadn't heard this one before, but it sort of struck me as probably ringing true and needing to be heard. Is that wealth is often created through concentration, but protected through diversification. What do you think about that, Tim? Is that fairly accurate?
I think it is, but I just you have to temper your expectations on all this stuff. I feel like I don't know. I that makes me nervous.
Yeah. Well, I mean, there's a time to build and accumulate, and then there's a time to preserve and protect, right? So
Right.
maybe in our 20s and 30s we could theoretically be a little bit more concentrated, whereas in our 60s and 70s we probably don't need the creation of wealth so much as we need the protection and preservation.
Yes, and the thing that I'm seeing with baby boomers is they get a number in their head that they have to get to at all costs. So I need to have 1 million. I need to have 2 million. And they're just racing and they're taking all the chances they can. And then when they get there, that's going to be it. And then you find people, well, I can take a little more,
And then it's not. They keep their foot on the pedal, right?
exactly. And that's killing me because I don't think people understand that, uh, we've had a really nice run here, a really nice run, and it makes me nervous.
Yeah. There's an end to the runway for a reason,
Yes,
right? Like
right,
take off or landing.
right.
You need to be done by the end of the runway, so to speak here. And I know they take victory laps in NASCAR, but they don't keep going full speed, right, Tim?
Right, right. And I just don't understand it. And we talked about this before, but that what that comes down to is that no one has taught anyone in the United States how to decumulate. Right? We are all about accumulation. My mom and dad would talk about, making sure you save money, make sure rainy day and all that stuff. But my mom is still alive, 95 and a half years old, and she's never talked to me about decumulation. So how do I do that? Well, she's lucky enough that she has a pension and then my dad's railroad pension. For me, I have to figure out how to decumulate. So that comes together with a protect and grow plan. And that all comes together as part and parcel with our planning is that we're going to take some of the risk off and we're going to show you how we're going to protect, but we're also going to grow your portfolio.
A more sound approach to volatility or the potential
Yes.
for volatility in the future, ladies
Yes.
and gentlemen. That's what the
Yep.
protect and grow plan is all about. That's what it
100%.
offers. So if you'd like to get that put together, again, pick up the phone, give a call. Tim Stearns, CFP, and the team from TJ Stearns Inc. have been a resource for so many proactive savers and investors throughout the Chicagoland area and beyond. But so many more need the kind of plan that will help you, ladies and gentlemen, protect and grow your wealth into the future. Goal and objective, specific to
Yep.
you, oriented to your goals, long-term time horizon and vision, diversified strategies for how to get there, but both sides, protect and grow, and a personalized blueprint for your situation. Pick up the phone, give a call, 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, you said that we have not been taught how to decumulate. And a lot of things. I sort of question, is this because it does not benefit the powers that be sometimes, right? And like
Yeah.
Wall Street isn't benefited when we remove money from it. Right. When we're investing money, the secret to investment success is as much as possible, as often as possible. And anybody on Wall Street is going to tell you keep on investing more, more, more if you can. The moment you suggest taking money out, it's a whole different conversation, right? There is not the same incentive there. They're not aligned.
I agree. And what's about to happen is all these baby boomers are going to be retired. They're going to need to pay their bills and they're going to start removing some of the money from the stock market. And you and I have talked about that. So that's a whole nother quandary. But I mean, at the end of the day, right now, when the market's at its all-time high and we can't really point to why that is, and we haven't, the other issue we're having, Peter, is that, look at in 2022, the market went down on average about 20%, and then it bounced back. And so people are like, well, it's going to bounce back again. The tariffs in April, went down and then it bounced back. So it's going to keep doing that. Well, what if it doesn't rebound? That ball doesn't come back up to you.
Yeah.
What are you going to do?
Yeah.
And that's why I worry, and maybe I'm a Debbie Downer here, but I'm just trying to be a realist
What's
too.
the what's the saying though? Plan for the worst, hope for the best, right? You're
Exactly.
creating the plan part, and then we go out
Right.
and live with hopes and dreams. And if you feel like that's not possible, that the market goes down and stays down, I get it because we haven't ever seen a period where it's done that. But just look at Japan's stock market from the 1990s till
Yep.
today. It went down significantly and has I think just now, 30 some odd years later, broken back above where it was. By the way, that's the time where Japan hit the peak of their baby boom retirement, which is where we are now demographically. Not that we're exactly the same, but I think that it
Right.
does make the case, Tim, that there is an essential reason and purpose for safety. And there's basically two kinds of safety that you talk about here on the program. One is protection of the lump sum and the principal, volatility and movement. But the other essential one, especially for retirees, is the protection and the safety for the income that we are generating and relying on. And can you talk about why that is so important?
Well, it's so important because that's how you're going to pay your bills. And so we've talked about this. If I could have a $10 million IRA account that, doesn't give me any income, what is that worth to anyone? Or I could have $1 million account that gives me $100,000 a year if I'm that lucky. So it's all about income and being able to pay your bills. That's how easy it is to look at retirement. So that you're able to buy groceries and that type of thing. And of course, you want to go and travel and all that good stuff. But at the end of the day, when we do a protect and grow plan, we're making sure the bills are paid every month, maybe by an annuity, maybe by a dividend paying portfolio that we can do or something like that that throws off income. And then the rest of it, yeah, then you can take a little more risk and get to see what the market can do with that money. But at the end of the day, we need to be able to pay our bills.
Well, no one wants to suffer market losses. Unfortunately, losses and volatility are part of the
Yep.
market and investment experience, and
Yep.
no one can accurately time or predict the market. So, considering protection, Tim, does not mean that you have to give up on gains, but it does mean
Right.
that you assess the realities
Yep.
that the market can be volatile. How prepared are you, ladies and gentlemen, for market downturns? That's what the protect and grow plan allows you to feel more confident about, that you are prepared for that, for the reality that the market is and can be volatile. And we are going to see downturns into the future. When those come, how severe they are, we don't know, but be prepared for them. And that is the Protect and Grow plan. Again, a courtesy service that Tim Stearns offers. All you need to do is pick up the phone, give a call, 800 640 2256. That's 800 640 2256. 800 640 2256. Or you can go online, tjstearns.com, tjstearns.com. Great resources, information, education available there, a calendar of events that you can attend, the book, Solving the Modern Retirement Riddle, available for download. So lots of great resources available at tjstearns.com, or get the conversation started. Get your own Protect and Grow plan and your risk assessment by calling 800 640 2256, 800 640 2256. Tim, always a pleasure. Appreciate you talking about a very important topic here, market volatility.
Thanks, Peter.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.